3, 2, 1. I don't like to say live until I actually see my face inside of the YouTube Studio application. But here we are. How you doing, friends? I don't like to say live until I actually see my face inside of the YouTube Studio application. All right, so that means... But here we are. How you doing, friends?
Mac Studio with Apple's new M1 Ultra chip.
That means, okay.
Device, but it also costs $4,000 US, which is 6 times more expensive than its younger brother.
Everything was going off at once. What the hell's going on here? All right. We've got everything under control now, folks. This is what happens when you're a one-man operation, which soon will be remedied, by the way. Here we are. How you doing, friends? This is Ernie with the 0 Days to Expiration podcast. This is episode number 85. Man, we're closing in on 100 very, very soon. And today's episode is a very special one. Although this may not be the exact date, it is pretty close, within a week or so, of the 1-year anniversary of the 0-DTE business, service, extravaganza, place to hang with 500 plus traders. It has been 1 year since I started or opened the doors or opened the, well, there aren't really any doors, the virtual doors of the operation. And it's been quite a ride. We have experienced a lot of great stuff, fantastic learning experience, both for the members as well as myself. The development of the strategy, the asymmetric strategy that we do, that is essentially 100% or 180 degrees opposite of the way everybody else trades 0-DTE. And that's a remarkable thing, and it shows, it's a testament to the staying power of this strategy and its efficacy. So what I'd like to do is take you on a journey, very, very quick. I'm not going to belabor this point or get into it and just make it. I just want to point out the high points of what we did, what we learned, and where we are and where we're going. So started off with just a few people that were interested in this strategy, friends, and those people are still with us. Can you imagine that? And we've grown steadily ever since. The idea was to do something that was totally apart from the way everybody else is doing 0-DTE. Now, first of all, what is 0-DTE? Well, 0-DTE by itself just means the 0th or last day of expiration of an options contract. Now, we trade a very specific options contract, with the underlying being the S&P, either the E-mini S&P futures or the SPX index. So we're trading options on those two things. And the reason why we do that is that there are 3 separate expirations every week. In other words, there are 3 contracts that are running simultaneously. They start about, I think about 8 weeks prior, maybe not that long, around that. Let's say 3 weeks, 5 weeks, I don't know. But they start a while back, and they expire, one on Monday, one on Wednesday, and one on Friday. If there's a holiday on Monday or Friday, then they switch that one to Tuesday or Thursday. So there's always 3. Now, I have it on good authority directly from the CBOE, the Chicago Board of Exchange, that is the steward of the SPX options, that as of April 18th, the SPX is going to host 5 expiration dates, Monday through Friday, as well as round-the-clock trading. So that's going to offer something very special. Now, why do we trade 0-DTE? We trade 0-DTE because of the extraordinary edge that you get with premium decay on the very last day of expiration. As if you're familiar with options, then you know that premium decays at an exponential rate, but it is particularly quick right as you get to the very end of life of that contract. And that presents an incredible opportunity, particularly on the last day. You would think, well, is there any premium left? You would be amazed at how much premium is left and how quickly it is decaying. Now, if you're collecting that premium with a premium collection strategy like a butterfly or an iron condor or credit spread, whatever it happens to be, you're the beneficiary of that decay because it's going into your account. So time is on your side. The other thing that's on your side is if vega or volatility has been elevated prior to the collection of that or the instituting or execution or opening of that position, and it's decaying or withdrawing. So in other words, if you had some economic reports in the morning that excited volatility, that would inflate or bloat the premium. You could get in there and sell that premium, and then as the day wore on and that volatility started to recede, that would cause the premium to decay even faster. So you have time and also the decay of volatility working in your favor. Of course, we do other things that make our particular implementation of this strategy extraordinary. So what most people do, and I talked about this in the last podcast, so go back and check that out and you'll see. So I'm going to only go over it very briefly. Most people take very, very risky positions, or I should say that their risk to reward is very large risk to very tiny little reward. And because of that, they have to stay in the position for a long time in order to capture that tiny little reward. And if price happens to move and challenge the risk side of their strategy, they could potentially lose many times, an order of magnitude greater than the amount of premium that they're trying to collect could go away in a loss. So they have this asymmetry going, but it's in the opposite direction. So I had fancied this premium collection for many years, right from the very first time weekly options were introduced with Apple, I think back in 2007. Is that right? So I was very familiar with the last day of expiration and how things work. But when I heard that the S&P was doing this 3 times a week, and I saw a few services out there that were doing this, I said, hey, look, I think I'll follow them and see what's up. And I watched, and I realized what their strategy basically was to put a very low delta trade on. In other words, a very high probability trade to capture any possible movement. Well, not any possible, but as much movement of the index as possible, and then try to capture that tiny little bit of premium there. So they would capture as much as 10%. So you put on a 90% wide spread, like an iron condor, you're potentially capturing 10%, but they never go for the full 10% unless they're very lucky. That only happens very rarely. They're usually trying to get out as soon as they collect half of that, or 5%. If price moves too far to the left or to the right, when you're in a trade like that, you'll know that the profit dome or the profit curve is very, very steep, and they suffer from gamma risk. And so what happens if they start challenging either the left or right side of that spread, they start going immediately into an unrealized loss. And that loss can be very, very large, sometimes as much as 10 times or more of the premium that they're trying to collect. So imagine you're trying to collect, say, $50, and all of a sudden you find yourself $600 down. Is that the type of trade that you want to be in? No. Of course, if you have the staying power, the will to stay in, and think that I am going to will price to stay inside of the profit tent, then, you can collect your $10, or your 10%, or whatever it is. That is if you have the will. Most people don't. So what they do is they put stops in to prevent them from going all the way and getting a max loss. And so when they put that stop in, they put it in such a way that the max they can lose is 3 times the credit that they're trying to receive. But because they only take 50% of that credit, it's really 6 times. So in other words, they take what is a very high probability trade and then squish it down to a relatively low probability trade for the benefit of collecting a tiny little bit of premium that they have to wait all day for it to achieve that kind of return. I thought, man, that just sounds awful. And so I decided to switch all that around. And I was in this one service and I said, look, I have this idea. Let's invert this whole equation. We know that price is going to move. Why are we trying to capture that move with a huge wide spread that's high probability that isn't really high probability because we cut it short? And then we have to wait all day for that profit to grow for that tiny little bit. And so I offered up a bunch of trades, and they were winning big money by putting in very, very little money up front. That's the other really drawback of this zero DTE approach of these other guys, is that it requires a great deal of margin in order to put on one of these trades to capture that little bit of money. So in other words, you have to put up about $1,000 of margin to capture about $50 worth of profit. And I just thought that was nuts. Why do that? Let's flip the whole script. How about we put up one part risk, maybe $100 of margin, $150 of margin, to go after $1,000 in profit? It's like shooting for the stars. You shoot for the moon if you come short. If you shoot for the stars, maybe you land on the moon, right? So you might reach the moon and get that max profit, but if you don't and you come up somewhat short, you still get a big prize for very little risk. And so that's what I started putting these trades out there, and they started getting annoyed because I'm putting these out and people are looking at what I'm doing and they're not paying attention to what the operator's doing. And so then the operator kicks me out. And I said, well, that's it. Obviously, I'm onto something. So I started 0-DTE.com, not 0DTE.com. All right, get it? I went 0-DTE.com to dash the way they were doing it before, and to come up with this new paradigm. And it was remarkably successful. We started in late March, early April of last year, and had a great streak going. It took a little time to get our strategy down, get all the content, the training, the methodology, write out exactly what our strategy was and what methods that we were using, what tools we were going to use. I was adamant that we weren't going to use any technical analysis because that just seemed like a non-starter. Everyone has this bizarre look thinking that technical analysis actually works, and for the longest time I've been an expert at technical analysis, but over time as a systematic trader I realized that it's nothing more than a coin flip. However, what does work, and what I had always seen working, is the analysis of volume profile, and then looking at the energies that come into a market, usually from economic reports. We're only talking about that one day. We're not talking about a swing trade or a position trade. We're talking about just a few hours that we have to know where price may be going. And so that's our opportunity. So volume profile is the perfect tool for analyzing market structure and seeing where support and resistance are and being able to predict when we're going to have an impulsive move or a trending move or a distribution move or a consolidation. Very easy to predict with volume profile. 20 times, 100 times, 1,000 times more effective than any TA that you could use. So I put these things together into a program, and it really took off. People loved it, and I just started piling on members. It started becoming more and more popular. We started throughout the summer. You would expect the type of strategy that we were using. We would put out of the money butterflies, asymmetrical butterflies, and try to predict direction, and price would move into the butterfly or anywhere close to it. And we could achieve anywhere from 100 to 200, 300, 1,000, 1,500% return on our risk. And at the same time, we're never sweating at all our potential losses because they're very, very tiny. Sometimes we could fashion an unbalanced or a broken wing fly so that we had no risk on, at least on the near side. But we found over time that wasn't the most optimal strategy because there were some times where price would move so far and challenge the other side, and that was not worth that risk. So we've reverted back to just symmetrical butterflies. And then after a while, started developing some criteria on what worked best, started working out the math, and found out that this strategy actually has a long-term positive outcome, where the other strategies that use complete inversion of what we're doing, where their risk is huge and profit is small, where our profit is small, our risk is small, and our profit is huge, ours has a positive outcome over the long term. Theirs has a negative outcome over long term. And there's a lot of treatises in Nassim Taleb's work in both his Black Swan and Anti-Fragile and Skin in the Game that talk about this very phenomenon. And so it made a lot of sense that it made way more sense to take small, tiny risks going after very large potential outcomes. Because the worst that could happen is that you lose that tiny little risk. But then there's this spectrum of things that you could gain from something that's multiples to orders of magnitude greater than the risk. It's almost like a lottery ticket sometimes. And last summer, we were hitting these or pinning trades almost on a regular basis. It was just unbelievable. And then as we got into Christmas, things started to slow up right at New Year's, and liquidity started to dry up. And so what we learned from that was that it made a lot more sense. And in January, liquidity just totally dried up, and you could find yourself in a liquidity trap in some of these trades. And so we developed from that the experience that sometimes it's better not to even trade, right? Imagine that, just not trading. So everything that we do is predicated on taking as little risk as we possibly can and waiting for the best possible opportunities to make very large profits. Our win rates are comparable to those people that are doing their, quote, high probability trades, yet our outcome is dramatically different. Now, there were obviously some bumps along the road in the learning process, like in these low liquidity, low volatility times with the market, and those are unavoidable. But the answer really is to simply be selective about the trades that you take. And if the asymmetry that you want in your favor, tiny little risk with large potential profit, isn't there, then we simply sit on the sidelines and wait for the next opportunity. And now, with the SPX going to be trading 5 times a week, and then we have the E-mini futures trading 3 times a week, and of course the SPY is also trading 3 times a week, there's plenty of opportunity. And if there isn't, we just sit back and relax. So that's where we are. That's where we've come to. It is a discretionary strategy, unlike some of these others that are trying to turn it into a systematic strategy, trying to produce an income when there's no possible way that you can produce an income out of a chaotic market. It's a discretionary strategy that gives us a lot of latitude. I've enveloped it in a continuous improvement process where each week on Sundays we perform a ceremony I call the retrospective, where we look back at what we've done and decide or review the trades that we made, and with a concentration on our execution. At first, we were looking at both our execution and possibly other variations of the strategy. And it took about 3/4 of a year to realize that the optimal was to just stick with the symmetrical fly, and that was it. And so now we're cruising. Our main purpose now is to focus on that execution, where we focus on managing profits, not risks, because the risk is already built into the trade. So a whole year to find all of that. And it's not, there's a lot to learn. And if you're an experienced options trader, the biggest thing that you're going to be learning is how to undo the thinking that you had before, that you had to take large risks in order to gain some profit, or put on high probability trades in order to have a chance at something. Those things are tough to put away when that's what everybody told you had to be done, until you realize it doesn't, that there is no reason to spend all that time anxiety-ridden biting your nails, hoping you're going after a tiny little bit of profit. Now, the other benefit of having that very large potential outcome is that profit comes to you quicker. So imagine the difference between having to wait a fixed amount of time, let's say 6 hours, the amount the market is open approximately. And with one strategy, you're going after $50 or potential $100, let's say. But you know that you're not going to be able to last for an entire day, so you're going to get out as soon as you can achieve 50 of that 100. And then in the other strategy, our strategy, 0-DTE, you're going after $1,000. So there are two things. One is that the premium is decaying at a linear rate, or not a linear rate, but at a rate much more quickly when you're trying to wait for $1,000 to decay as opposed to $100 to decay. That just makes sense, right? The other is that we don't have any stops. We're not worried about that. We have no gamma risk that we're worried about. We're in and out of the trades much more quickly. And then if we want, after we've done well early in the day, or if a trade looks like it's going to hang in there and possibly pin where we can make huge returns. There have been some trades in the past where we've made as much as 1,800%. 1,800% on risking, let's say you risk $150 and you make 18 times that. Those are good days. Now those happen far less frequently, about 5 to 15% of the time. I usually say 10 to 15% to give us a little bit of leeway where we can pin that trade. Most of the time we're waiting for those 150, 200% returns. Like today, most people got out with about 150, 200%, some a little bit more. We have other strategies where if we're deep into the day and it looks like we could have some staying power and you have multiple positions on, we'll realize the profit in enough positions to guarantee us a profit no matter what happens. And then see if we'll let the rest of the positions go on what we call a free ride and see if we can actually pin that trade and go for, instead of 150, maybe 1,000%. So that's what's happening today. Everyone already got out with their nice profit, 150%, not 5%, not 10% of what the other guys are doing, but 150 or 200%, some people more. And then some people now with multiple positions are there with their free ride, waiting to see if they can capture the big kahuna. So that's 0-DTE.com. We offer a 4-week trial where you become a member just like any other member. Our service is dedicated to teaching you the system, the entire system, the strategies and the methodologies and the process. It's not just a black box alert system like the other guys. When you join, you get my phone number. You can call me anytime. As a matter of fact, you can call me anytime too. You just go to my website, you'll find my number there if you want to know more about this strategy. What other service do you know where you can call up the operator and ask questions directly? There are none. It's as simple as that. And for the price that you pay here, it's just an unequaled value out there in this world of financial services. Now, I'm not saying that we win all the time. There are times that we don't win, but what we're really working on is how to find those times where we have less of an opportunity and simply avoid them. That's one of the great things about going after asymmetric returns. You're always going after the big prize or a bigger prize. So you're never experiencing those big drawdowns like you do in other strategies. Just a nice, smooth, stepped-up equity curve. Sometimes you're flat because there's nothing to do, but then when it comes hard and strong and positive, it's possible that you could have multiple losses, but very tiny losses in a row, but they don't hurt. The hard part is keeping your wits and your directive in front of you that you only trade small. You only trade small for the potential of returning big. You're never really committing a huge part of your trading capital. You're only committing a very tiny bit. So that means that you can trade with a small account too, with potentially large outcomes. So there you go. That was the journey that we've had on Zero DTE. We've learned a lot, and we're continuing to improve. It's a fantastic service. Go to 0-dte.com/try. Do a 4-week trial. After that 4-week trial, if you want to join, I will rebate the cost of that trial. If you don't join, the worst that's going to happen is you're going to get the cheapest, most unbelievable training, 4-week training that you've ever experienced. All right. That's about it. We got to get back to this trade. We want to see if we can get a last hour trade now that we've got a win under our belt and see if there's something there. Look for some low-hanging fruit. If it's not, then we'll just chalk it up and say it's a day. All right. Thank you very much for joining me. Take care. Peace. And we'll see you Friday, the next 0-DTE day. Bye. We got one question from the Peanut Gallery. Lance, what sort of asymmetric trades can we use for stocks with only for Friday expiration? Well, you can use the same methodology that we use for stocks, there's no doubt. In fact, this strategy, I think, can scale to just about anything. The NASDAQ also has 3 expirations per week, and that could be another thing, but we find that its liquidity is low and its volatility might be too high. But for stocks, you could certainly do this. We'd have to think about that, but that's not really where the opportunity is. The opportunity is with the S&P. But yes, stocks, we could use the exact same strategies, maybe just slightly different criteria for our selection process. Thanks for the question, Lance. All right. Now, peace. Take care. Okay, got the off button. And we're gone.